So obviously right now we're looking ahead to Procter & Gamble. That reports later this morning ahead of a number of these consumer staples names reporting over the next few days. We're talking Coke, Pepsi, Colgate-Palmolive, the list goes on. Is there a metric that you're watching when it comes to this sector? Is it free cash flow? Is it margin? Is there something that'll give us a sense of what direction the sector is going in?
Sure. There's two key metrics we're focused on, Frank. We're focused on organic sales growth, and in particular, the composition of organic sales growth. How is volume holding up? How is price holding up? And then secondly, we're looking at gross margins. Let me delve a little bit deeper on that. First, on the latter, gross margins have been under pressure for the industry for a while. P&G specifically, 7 consecutive quarters of declines is in the tank. There's been a lot of inflation out there. These companies have been aggressively trying to catch up, grind out productivity, catch up on price. You've seen it in some of the headline CPI numbers out there. They've clearly been pushing through price. This should be a quarter where we get an inflection point, where the price growth we've been putting in place is up and it sticks. Meanwhile, we get moderation of the rate of inflation. So our price net of cost, which has been a deficit for 7 consecutive quarters, should flip positive this quarter. That's clearly a positive tailwind. Now, if that can happen with organic sales growth holding strong as they have been, then we clearly get earnings acceleration. So this should be a sweet spot for the sector that we're entering where earnings accelerate. On that organic sales growth figure, historically, the 10-year CAGR for P&G has been around 3. The last 3 years, they've been growing close to 6. And a lot of that is because of the excess prices in the system. They've also been performing well in market share. So clearly, if we can hold that 6 with the margin expansion, it's a pretty good place for the industry to be. And we should and could find ourselves in a positive estimate revision cycle. And that's a broad-based brush that I think I can paint across the entire industry.
All right, so you're painting a lot of tailwinds there, Jason. I know you say there's one more tailwind when it comes to consumer staples. You put out some research a month ago. You have estimates that Goldman Sachs has worked up that consumer disposable income, it's going to increase 8% this year. It's your estimate, a 20-year high. What could that potentially mean for these names?
It kind of ties back to one of the questions you asked about whether or not the consumer can weather these price increases, which is another area of focus that we're going to have today. So back to unpacking organic sales growth, we know that price should be rich. One key question is how much degradation do we have on volume? We get too much degradation on volume, that very rosy scenario I gave you could unwind. That brings us to the research you just mentioned. Everything we see from the consumer suggests they should be able to continue to digest this inflation. So as you noted, our work gets us to a forecast of discretionary personal income nominal before we contemplate inflation, growing 8.1% this year. That's a multi-decade high, very robust income that stems from the tight labor conditions, high wage inflation. Now, last year, that picture looked very different because, yes, we had high wage growth, but we were cycling stimulus. On top of that, the consumer had to pay a lot more to feed their family, fuel their car, heat their home. Essential expenditure inflation was substantial. This year, it's moderated meaningfully. We're lapping the run-up on gas prices, resulting in meaningful moderation on energy price inflation, and even food at home inflation is beginning to show signs of moderation. So I get better top-line income into the consumer, and I don't get the same magnitude of degradation of spending power coming from essential expenditures. That leaves me with a substantially better position on how much is left in the consumer's wallet to go out there and buy discretionary goods or absorb some of this inflation. So all of that leaves us relatively constructive on consumer spending outlook this year, and I would say arguably more constructive than most of the headlines I read.
All right, so how are macro factors impacting these names in this sector as well? I'm talking about the falling dollar and also what seems to be gradual reopening of China.
Well, a couple of things. First, from a stock price rotation, the macro factors generally have proven to be a headwind because some of the concerns and consternation around rolling into recession this year have abated, and a flight away from safety has weighed on the group. That's vacillated as regional bank failures come into the focus, et cetera. But from a fundamental perspective, the dollar has weakened. Most of these companies, particularly large ones like a P&G and Estee Lauder, they've got big multinational footprints. So when the dollar is strengthening, that international income is effectively shrinking when they translate it back into U.S. dollars. So we like where the dollar is going right now relative to where we last quarter. We're going to mark our models to market. FX is a less pronounced headwind, so we're going to be revising things higher. You asked about China and the reopening. It's a little early. We're going to get a lot of data points in the next couple of weeks from these companies talking about what they're seeing on the ground. What we're seeing so far suggests the mosaic is flashing more green than red. We're seeing on-the-ground mobility statistics improving. We heard from LVMH with their perfume and cosmetics division, overall luxury division last week. They had good things to say, particularly as the quarter progressed. Same thing from L'Oreal, who just reported over in Europe. They talked about a bit of a slow start in the quarter for China, but the exit rate at strong double-digit type growth. So it looks like we're really turning a corner in China and getting good momentum. And that matters a lot for some of these companies. P&G, China's their second largest market, roughly 8% of sales. They're the largest consumer packaged goods company in China. Another company of mine, Estee Lauder, derives almost 40% of its revenue from the Chinese consumer. So China alone is very important for some of these companies.